Good day, fellow investors. Taxes and investing. There was this great comment on my research platform video asking, how do I take dividend taxes into account? I live in a country with 30% tax on dividends, plus the taxes from the country where the company is based. In this context, value investing and compounding based on dividends is impossible. Let's discuss that and how to apply those tax situations to your own analysis of things. I really don't focus on taxes as Prasant says here because I occasionally comment on it because taxes are different for individuals from many different countries with different tax rules that we have on the research platform, for example. So we have to understand those taxes individually per country, although the members will share their knowledge with each other for different countries, which is helpful. So that's my take on taxes, but let's dig deeper how to apply those individual situations to the valuation quadrant. And we just discussed Archer Daniel Midlands, and you will never see tax discussions into stock analysis, business analysis, or something like that, because the taxes are individual. And therefore, you have to apply your tax situation to that analysis on top of the initial analysis. Just to note, this is now part of the value investing course that I am building through this year. Check it out, subscribe, you get an email when there is something new from educational perspective. Over the year, we'll make quizzes and then also certificate when the time comes. Join it in the link in the description below. Let's dig deeper on taxes in investing, individuals, how those depend on various accounts, the international complexity of it all, the dividend tax, capital gains, holding time, tax harvesting, and implementing it all into a calculation. Of course, you have Roth IRAs in the US where you pay no taxes, so that's always a positive. And that's why also you see no taxes in calculations, because some people have it like this. And the thing is that if you can maximize your tax-free returns, that is always great. Because if you invest $7,000 per year, 10% return, and no taxes for 30 years, then you have 1.2 million. Compared to 15% taxation yearly, that's 23% less because it always lowers you also your compounding. So 15% versus zero tax here example. So you can also get a traditional IRA where you will be taxed in the future when you withdraw and your income will likely be also lower. So the first key is with taxes, allocate your investment to a proper vehicle. However, this is also something very important. I so often see people focus on taxes, and I can guarantee you people are so blindsided that you will see in the comments how taxes impact their thinking. And please write how taxes impact your thinking, because that is the key process here with this video. People focus so much on taxes that they are focusing on taxes, not paying them, thus not getting gains, and you certainly don't pay taxes then, versus focusing on quality investment and risk and reward. Let's do some examples. We have discussed Rubis, which is a French dividend stock, and there is for some a 30% French tax on dividends, and now that has to be implemented into the calculation if you have that for you. So without taxes, the dividend payout ratio is 100, but if we implement the 30% tax for us, then the dividend payout ratio is not 100%, but 70% on a dividend calculation. That changes the present value of the dividend payments. It also lowers the intrinsic value. And this is something you have to implement for each company that you follow, share on your stock comparison list. That's the start. Further, we can discuss capital gains. Let's say that Berkshire, the value now is 1 trillion. Let's say that in 10 years it trades at 2 trillion for 100% increase in profits. If you have to pay 30% on taxes, you have to go to the Excel sheet and lower the outcome there by 30% if you think you could possibly sell Berkshire at that point in time. If not, if you just keep owning forever, then it's a different story. This is the intrinsic value table that we have to be downloaded for free on the course. Feel free to do that and then play around. But this is something that you have to have in order to compare your investment opportunities. And you can see here, Rubis, if we look without taxes, then the return is positive and above 10%. However, if I change the dividend payout ratio, lower it by 30% on taxes, then you can see immediately here, now the ratio, comparative ratio there is much lower. The return is not above 10%, is below 10%. And you compare that to other opportunities. If you are heavily taxed on dividends, then that is implemented. If you are just on capital gains or no dividends, then you will compare then, okay, Rubis at this price versus Berkshire that doesn't pay dividends for me. But still depends on the price paid. Don't lose the focus on the risk and reward and price paid comparing to things. Let's discuss also Archer Daniels Midland and then see how it goes there. With no dividend tax, so if you have it in a Roth IRA or something like that, the intrinsic value is now 42 or 46 depending on the scenario. If we put a 70% dividend payout, you can see here that the intrinsic value didn't change much. If we go to the comparative table, 10%, 9% return. If we put 100% here without dividends, it's still around 10%. So even a 30% dividend on a stock like this is not that disastrous because there are other components to that, and that is the growth rate, the future potential, the capital gains. So even a dividend stock could fit a dividend portfolio like the one discussed where dividend taxes are impossible. But you have to implement that and then compare. That's the key. Because if you just shun away because you have to pay taxes, you will invest in more expensive companies, and that's something that you want to avoid, even at the cost of paying taxes. So the main message is focus on investing, don't focus that much on taxes. Implement and forget. We don't have any miraculous way of avoiding taxes as Westco and Berkshire is also Charlie Munger's message. And as Charlie Munger says, when someone comes you with a tax shelter, things like that, legal tax avoidance schemes, run away, because it will cost you much more over the long term rather than focusing on investing. Because let's say that you invest in something and it's expensive, it goes down 50%, your final wealth starting from 100 is 50. So even if it does nothing, you're still at 100. If you invest in something that doubles and you pay 30% capital gain, your final wealth is still 170, which is better than 50 or 100. Taxes or no taxes for you? You answer that question. Let's go to tax loss harvesting, holding to pay no tax on gain. This is a common question. So something is down, should I sell to gain that 10-20% savings on taxes? Or something is up, should I wait 2 years because then I don't pay capital gain taxes? This is a very common question, especially in December I get a lot of these questions. The answer is we cannot know what will happen to the stock price going forward. So again, implement the risk and reward of you gaining, 10% on less tax payments by selling versus what can happen in the long term. If you sell something that's extreme value and cheap, and then before the tax loss window of 30 days closes, it goes up 20%, then you lost more than you gained on those taxes. So that is the risk and reward that goes into gambling and drifts your focus away from proper investing. My take on taxes: I am now in a 10% bracket for both capital gains and dividends. I'm in Croatia. I have my stocks under my business. My mother in the Netherlands portfolio that I manage, the model portfolio, is no capital gains and dividend, 15% dividend taxes depending on the country treatment. And the thing is that I wish to pay 20% on my taxes because then I make more money. That's my goal, and that's something that, again, I have to personally implement. My message is pay taxes, focus on investing, and you'll be happy paying more and more taxes in life. I'm looking forward to your comments. Thanks for watching. I'll see you in the next video.